Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vinny Motiwala. And it's a strong start to the trading week. Benchmark indices holding with a gain of nearly 1% at 11 o'clock. The Nifty is closer to 24,250. Reliance Industries 4% up move. 4.5% up move is a big contributor to the gains today. Banks are doing well. Yet again, the Nifty banking index moving lockstep with the benchmark indices, and Pharma is having a strong day. So that's up close to about 2%.
Absolutely. Good morning, Reema, to you as well. An interesting day coming in. While Pharma is managing to hold on to gains, we're seeing a bit on the flip side. IT, that's not managing to do well. It's down 0.7% in today's trading session. Now, that's one of the sectors that is only trading in the red today.
But you know, that's also because last week, the Nifty IT index was up 7.5%.
True.
So it just got re-rated last week. So there is a bit of profit booking.
Why not? Why not? And like you can see on the screens as well, in terms of contribution that are mainly coming in, Reliance, like Reema mentioned, and other than that, banks are the names coming in. Private banks specifically are seeing a good up move in today's trading session as well. Broader end of the market, that's also managing to hold on to gains today. So whether you look at the Nifty mid-cap, holding on to gains of 0.8%, small cap managing to hold on to gains of almost 0.3% as well. So good day coming in for the markets as of now. Look at individual names on the broader end of the market. Ramakrishna Forging, MRPL, Cochin Shipyard. These are some of the names in the last few minutes also. I've managed to see some bit of an up move. So that'll be interesting to watch out for, Reema.
Okay, let's straight away get to and invite the first corporate on our show today. That's Mahindra Holidays and Resorts. They've reported about an 11.5% drop in the profits in Q4. The company's top line too has declined by 2.7%. Joining us is Manoj Bhatt, MD and CEO of Mahindra Holidays and Resorts India. Mr. Bhatt, thank you very much for joining in. This is Reema here. Let's start with your top line. While for the full year, FY25, you've clocked in a revenue growth of 2.8%, in Q4, things seem to have slowed down for you. There was a drop in your revenues. Can you explain that? And, you know, what was the reason for that? And what can you guide for the first half of the year at least?
So first of all, thank you, Reema, for having me on the show, and good morning to all the viewers. So if you look at our numbers, firstly, I think Q4 is a quarter where there are two things which are happening. I think the India business showed a very strong growth, but I think our Finnish operations were not up to the mark in terms of the performance there, and that's because of the weather pattern changes there and the economic kind of conditions. So that's the reason for the minor drop. But I think if I look at profits, I think if I exclude some of the one-offs, I think the one-offs are pertaining to potentially some of the forex swings which have happened recently, as well as, you know, some tax refunds which we had in last year. I think on a full year basis, our profits at the consolidated level, excluding one-offs, grew 37% YOY. So which kind of reflects the core strength of the business. Also, if I look at just the India operations, I think that has shown a 25% profit growth year on year on a full year basis. So I think we are seeing two trends here. So one is, of course, some seasonal variations caused by weather in Q4, but otherwise, pretty much on the bottom line, I think a very strong performance.
Tell us a little bit more about the Finland business, because this is not the first quarter, you know, which where a poor performance there has impacted your revenues. I remember even in the prior quarter. What exactly is the problem, and when will it get resolved? Are we seeing early signs of an improvement there?
So if you look at what's happening in Finland, I think two or three trends. So one is probably the overall economy is not doing well, which if you look at our business, I think there is, of course, the vacation ownership business as well as the conventional hotel business. Those are the two things we do in Finland. I think both of them have been impacted. The second thing is, of course, more long-term is about the Russia-Ukraine situation. And a lot of Russians used to visit Finland, and that's kind of affected the overall business. And the lastly is about some changes in taxation, etc., which has been happening at the local level. So that's come up kind of in the past. I think as we look forward, I think two or three positives. I think the economy is expected to bottom out and start potentially growing. So that's positive for the business. The second thing which is happening is, I think, and this is kind of looking into the future, whether any reconciliation is possible on the Russia-Ukraine thing, and that could be a real positive for the business, because I think a lot of the business was also impacted by, or rather benefiting from Russians visiting it. That should really help the business, I think. And lastly, I think today the team is focused on, the operating metrics at the bottom line and cash management. I think not so much on the top line, because the economic conditions over the last 12 to 18 months have not really supported a lot of top line growth. So that's where we are. I think my own sense is that we are working on this, and I think we will look at the trends which are coming out from an economic perspective as well as a geopolitical perspective. And I'm hoping that that should be an improvement from where we are today.
Hi, Mr. Bhatt. Good morning. This is Vinny joining in the conversation as well. Mr. Bhatt, what I want to also know is in terms of the outlook that you have for your quarterly membership, the run rate that you have over there, right? In Q4, I believe you added around 2,118 members. FY25 around 12,393. But Q4 specifically has seen some bit of a decline, right? So what is the run rate expected going forward in FY26 quarterly, as well as 5,000 anytime on the card soon?
So I think, Vinny, that's from a membership addition perspective, I think it's a broader view we are taking. And the view we are taking is, I think that how do we improve availability overall? So if you look at our last year's summary, right, you're right, at around 12,400 members we added. But also we added a lot of rooms. We added about 520 keys, which is the highest ever in our history. And what that does is it brought down the member to room ratio. And so it's about 52 members to a room from 56 last year, which has actually helped in terms of making sure that the member availability goes up. So that's our first focus area, which is driving better customer experience. The second thing which we did, and I've spoken about this in the past, is looking at which are the kind of members our offering can serve really well. And so we have exited certain markets, exited certain channels during the course of the year, and focused on getting the right kind of membership inflow, which then we can service better over a period of time. I think both of these have contributed to the contraction in memberships, but my own sense is that's probably going to be a trend. I think the past kind of membership addition is not what we are targeting. We are focused more on making the overall customer experience better and premiumization of the product, if you will, which then kind of means that the volumes could dip a bit. But I think if I look at the overall metrics around what we track is average sales value, that's up very, very sharply. In if I look at even F25, it's up about almost 40% plus in terms of average sales value, which then denotes the kind of members we are attracting are more premium in nature.
Right. Mr. Bhatt, then if you're focusing also on premiumization, that's one of your strategies as well. I just want to overall understand how does your margin profile change as well? What is the expectation in terms of FY26 margin overall for the business, as well as, the EU side of the business? What is the EBIT target on that front, given that there was some bit of a pressure there?
So I think let me first talk about, I think the overall business at the consolidated level. I think from our perspective, if you look at Q4 numbers, it's been a very strong performance on the India business. And if I look at reported numbers were up about 72% Q4 to Q4 in terms of PAT. And even if I exclude some of the one-offs, I think it's about 61%. So very strong performance in profit growth in the India business. Coming to the EU business, I think our focus there is to maintain and slightly better performance into going into the next year. I don't think we are building in any dramatic improvements there. But when I combine the two, I think I do believe that our profits will go up. I think if I look at the last full year, excluding some of the one-offs, I think our profits grew about 37% year on year. My sense is that it'll be slower than that, but I think we'll definitely see a growth in profitability as we go into F26.
Okay, Mr. Bhatt, thank you so much for joining in with us this morning on the show, explaining us what to expect from the company going forward in FY26 as well. It's a pleasure talking to you this morning. But on that note, we're going to slip into a very short break, and a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open soon. Scan the QR code now and submit your entry for SME Champion Awards Season 2. Welcome back to Trading Hour on CNBC-TV18. Now let's bring on board Soni Patnaik, who's joining in with us to give us a quick check on the technicals on the market. What is happening over there? Soni, good morning and thank you so much as always for joining in with us. Markets, what are you looking out for in terms of levels today? Yes, we are seeing that bit of an up move that is coming in. But what is important to track for the Nifty as well as the Bank Nifty?
Hi, good morning, Vinny. Thank you so much for having me on the show. So I think it's very simple when it comes to Nifty. It has defended 24,000 on Friday as on closing basis. We've seen a very strong recovery from those levels. Now, again, it is reapproaching the resistance which it was facing the previous series, that is around the 24,350 odd levels. Very crucial resistance and fresh upside can be seen once this level is crossed. So any move above 24,350 can take Nifty towards 24,600 and above that would be 24,800. So these are the levels to watch out for. We would continue to hold longs for Nifty as long as 24,000 is defended on closing basis, and look for targets towards the 24,600 plus levels in the next 2 to 3 days. Coming to Bank Nifty, I think Bank Nifty is also approaching its resistance of around 55,500. Now that's very crucial because it has a lot of call writers positioned themselves around that level. So it has to move above 55,500 so that above that it can move towards the 56,200, 56,500 levels. As of now, all bets could be on Nifty as it seems to be holding that mark, and any move above the 24,350 levels, you can see it heading higher.
Okay, and Soni, what are the stocks that you're tracking as well on the technicals?
Right, so both would be on the buy picks today. First buy pick is from the defense space, Bharat Electronics. It is an official recommendation. One can buy BEL at current levels, keeping a stop loss of 300 and a target of 320 to 325 can be seen. It is just approaching a fresh breakout above a 310 levels. Any move above that, you can see it heading towards a 320 plus levels for May series. The second buy pick is in ONGC, again an official recommendation. One can buy ONGC around 249 and on any declines up to 245, keeping a stop loss of 237 and targets of 265 to 273 can be seen.
Thank you very much for that. Let's talk about Maruti, which holds a huge share in India's passenger vehicle segment, has flagged concerns on growth. Sudarshan now joins in to give us details on this. Sudarshan.
So Maruti had held an investor call after its Q4 earnings on Friday, and today you can see that stock is currently high or say off lows. Now it has talked about majorly two topics. First, FY26 outlook, and second, why entry-level sales remain a concern. So first, talking about the FY26 outlook, company says that if you would have heard SIAM, it's expecting FY26 domestic growth to be in the range of 1 to 2% versus 3 to 4% that we recorded in FY25. So here the picture is not that bright. But what might hold good for Maruti is its export growth is improving. In FY25, its export growth was 17%. Now it believes that in FY26 that growth can increase to 20%. So that's the reason total sales might improve going forward. But the entire industry is talking about the entry level where Maruti is the leader, and why the sales have been falling. It's not been falling for the last 1 or 2 years. It's been falling for the last 5 years since 2018 and 2019. Now, what was the reason? If you compare from that level, currently the sales are 10% lower. So RC Bhargava has given few reasons. First, if you talk about the household income for people who are earning less than 5 lakh, there are 200 million of total 300 million households who are earning less than 5 lakh. Now the cost of these cars, of entry-level cars, if you take, for example, of Maruti, Wagon-R, Celerio, price of these cars have increased significantly over the last few years, and that's the reason people who are earning less than 5 lakh have stayed away from buying these cars. Also, another 30% of households have income in the range of 5 to 12 lakh, and this bracket also has kind of stayed away because of increase in car price. Why the prices have increased? So he has given few reasons. First, like regulatory changes. Second, commodity costs have seen a sharp increase. Now, what does the industry need? If you would have heard in the budget, Finance Minister had announced that income tax would be reduced. And second, upcoming 8th pay commission. So will these two help improve the demand for entry-level car? As per RC Bhargava, the big answer is no. He believes that government has to do GST rationalization to improve the demand. Let's listen to what exactly he had to say on this.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market. The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen. People at the entry-level segment have numerous demands on their income. There are people who don't generate surpluses every year. And a lot depends on each family what their priorities are. The amount of money which is required to make up the extra cost of buying a car runs into 70,000-80,000 rupees. I'm not sure how much money this income tax refund will give, or not income, but lower income tax rates will give them. Will it give them enough to afford to buy a car and pay for the higher installments? Some families maybe yes, some families no. But we have to see, this thing just started, the impact has just started to come.
Okay, on that note, we know we're going to slip into a very short break. Up next, we'll discuss the market fundamentals with Nilesh Shetty, Portfolio Manager at Quantum Advisors.
Welcome back. Nilesh Shetty from Quantum Advisors is now with us to talk about the market fundamentals and his top sectoral bets from here on. Nilesh, things have dramatically improved from the last time we spoke about. When we spoke about last time, we were in the midst of a very steep correction. Stocks were getting derated, and now we've snapped back higher. Even in sectors like IT, where there was a marked disappointment in terms of the numbers. What have you been doing in the month of April?
Yeah, unfortunately, we've been trimming a bit in the month of April. Like you said, in the month of February, when the markets were correcting quite sharply, we saw some opportunity to deploy some capital. But after that, the rebound has been very, very sharp. So we've had broad weights, large weights in financials, in two-wheelers and IT services companies, of which the two-wheeler pack is getting expensive for us. So we've been trimming because they've had stellar 2024 as well. But apart from that, getting value outside of these three investment basket has been very tough for us. So our cash levels tend to be relatively elevated. Even today, it's about 14%.
Okay, you spoke about private banks, two-wheelers and IT. These are the dominant holdings for you. In that, two-wheelers is now getting expensive, so you're trimming your positions.
That's correct.
Okay. What about IT? What did you do in the month of April? Did you add on to any positions? Or, I mean, how will you navigate, I mean, looking at IT, say, for the next 6 months?
Yeah, unfortunately, IT may not be a 6-month play given the uncertainty around recession, probably in the US, and this risk of AI. You may have to be a bit more patient as an investor. What sort of we like was valuations where they were at the lower end of the historical bands. But we don't see any meaningful catalyst over the next 6 months. You may have to be patient. Perhaps once this uncertainty recedes a bit and US corporates start investing back again in the discretionary spends, you may see a pickup coming in revenues. But till that time, these stocks may sort of hover in a small range and they may not go up materially.
Okay. So wait out at least for IT. You're not going to get near-term gains. Maybe there may be something that you should watch out for, but long-term, it's a good story. That's what you're saying. Nilesh, what's your thought coming in on any other sectors? You're finding value anywhere else? Obviously, we've seen the correction coming in the recent times. So something like a pharma, real estate, anything on that front that you would look at?
So the portfolio sort of is a value portfolio with the governance filter. So unfortunately, real estate, we've not had companies pass a governance screen when we are evaluating a lot of these companies there. So we've never had allocation in our last 25 years to real estate. Pharma is something we've been watching very closely. So when Mr. Trump announced there could be significant tariffs, you saw some correction coming off, but then they rebounded again. But that is probably you will see some names come through. We are watching the consumer durable space and the consumer staple space closely. There has been correction, but the valuations were so high, they still, despite the correction, are expensive. But if this underperformance continues, we expect more names to come through in that basket. But barring that, very few opportunities outside of that.
Okay, very few opportunities there. So, Nilesh, then are you going to be waiting out and watching for the earnings season to, pass by and then look at adding something? Or, what is your thought process right now?
So the portfolio is stock specific, so there could be opportunities that may come anytime. And again, we are sector agnostic. So whenever we find a stock coming at levels that we are comfortable with, we are happy to buy. Right now, the closest that I see is a pharma company and probably a couple of consumer durables company if they come through. But again, nothing immediately very close to our sort of levels that we would be adding them to the portfolio.
And pharma would that be focusing more in terms of the domestic side of exposure, or companies which are more focused towards domestic side? Given we still don't know what's happening on the tariff front, right, in the US. So would that be more domestic facing?
No, the correction has actually happened in the companies which are facing more to the US, and that is where we think there could be an opportunity if you assume things will normalize. So if you go with that assumption, the valuation correction will give you an opportunity to add some stocks there in the portfolio.
Since private sector banks or financials is your top holding right now, and you've been bullish on it, with the right disclosure, can you tell us some of your picks there?
So we've been primarily focused on the large private sector banks. You take the top 3 largest private sector banks, we have them in the portfolio. We've been holding them for a while now. I mean, last 3 months is when they really started outperforming. Before that, they were underperforming for a long time. So we think there is still significant upside there. They've still not moved materially enough for valuations to indicate they're expensive. Our sense is they're probably in the early stages of a rally, which may last for the next 2-3 years.
Okay. And outside of the top 3 private sector banks, do you have any financial exposure?
So we are very bullish on the insurance space, both life and general. Valuations have been attractive there because of a lot of regulatory headwinds that came through. I think there could be more names actually which may come through there in the insurance space.
And nothing in the mid-cap arena in at least when it comes to financials? Like today, for instance, you've got an RBL bank, DCB bank. They're all up 8-9%.
No, we have a penchant to ensure that we don't want to worry about the bank once it's in the portfolio. So, like I said, in the mid-caps bank, there are other issues, concerns on the book which may come up, which we don't want to be exposed to. So we actually just stuck to the larger well-known names.
Okay. Nilesh, thank you so much for joining in with us, giving us your views on the market as well as sector-specific especially coming in on the banking side, IT, pharma as well. It's an insightful conversation that we had there. But on that note, we're going to slip into a very short break, and we'll get back the co-founder and managing director of Rossari Biotech after the break to talk to us about their numbers. Welcome back to Trading Hour on CNBC-TV18. Let's move on and talk about Rossari Biotech and shift our focus there. FY25, they reported their numbers. Met the revenue growth guidance that they had given of 12 to 15%. The growth came in at around 14% for FY25. EBITDA margin slightly below the guidance in terms of the range of 13.2 to 13.5%. We have the management of the company joining with us, Sunil Chari, co-founder as well as managing director of Rossari Biotech, to discuss the year gone by as well as what is the outlook for the company going forward. Good morning, sir. Thank you so much for joining in with us on the show. And, what I want to start by asking is in terms of your FY revenue growth, right? You had given a range of around 12 to 15%. You came in at around 14%. Now, this is specifically when I'm looking at the HPCC segment. That's our good growth as well. What is your outlook for FY26 in terms of the guidance that we're watching out for? Similar level of growth is something that we could see continuing, and the segments that will be driving the growth.
Good morning. Last 3 years have been very volatile for the chemical industry. As such, if you see all our peers, we have been able to navigate these volatile times very well. And I feel the future is very good. Even the future looks uncertain. The world is very volatile. We think that we will grow very well in the coming years, especially now that we have done some expansion last year. We are practically at a very low debt level. The net debt levels are at just 70 crores. And in the 3 main companies where it is our B2B business unit of Rossari and TriStar, we have 0 CC utilizations. And in Rossari and TriStar, we have 0 term loans. We have announced some more expansions this year, and we see good possibilities for both domestic and export. Last year, exports were 27%, and we hope to continue with the same exports percentage of the total sales or more. Export seems to be an area where we want to focus, as I've said in all my past calls on CNBC. In terms of R&D, and that is where we have scored over our competition, our peers in India and abroad. And the ethoxylation chemistry is something where we see we can grow volumes. And then there are other areas like esterification. And our R&D lab at IIT Powai is churning out new products regularly. And this is giving us an edge in winning more market share. HPPC, as we said, is now more than 70% and growing continuously. But the textile and the AHN business continue to do well. And we hope all the 3 segments will grow well. Last year also was heartening that we grew on the volume front. And then we had about more than 10% growth on the volume front. In terms of quarterly, the quarter 4 normally is not the highest, but we had the highest sale in quarter 4 last year. I feel in the coming days, the markets should reward us well in terms of market share in all our shares, because quality, consistency, supply timing is something which are liked by our overseas customers, and we've done well with this.
Mr. Chari, morning. This is Rima here. Let's talk about exports, since that's clearly a focus area, as you highlighted, and you did very well last year. I think the growth was about 27%, which was ahead of what you were also anticipating at the start of the year. Now, given the tariff uncertainty, how has the export outlook changed, and what can you guide in terms of an export growth or export contribution to your revenues?
So I was in China last week, and I think this is a golden time for Indian specialty chemical exporters to US, to the American markets. We should all grab this opportunity. This is a once-in-a-lifetime opportunity which has come up, for us. It may take time to get approvals. It may take time to get customers to buy the products. but we should all renew our efforts to win a greater share than what we have in the American market. But also Europeans, they are following the Americans, and we see a good possibility for us to expand into both these markets.
Okay, expand into the markets, but what would be the growth that we're watching out for in FY26? This time, surely it was a very good growth. Rima mentioned 27%. A number that you could give us in terms of a guidance that we should keep an eye out on.
So I think, because I cannot predict the future, the China, Taiwan, the US, Ukraine, India, Pakistan, I would go by at, double-digit growth, maybe around 10-15% growth. That is what I would like to, give guidance today. But we will pray and work hard for certainly more.
And 10 to 15% even for the overall business?
Yes.
Okay, so 10 to 15% for overall, but export you've been outperforming. So won't you do better in exports, given the golden opportunity?
So we are 25% plus, and we would like to be, what we were 27% last. We want to grow higher than 27% in exports, and I think we should do much better than what we did last year in exports.
Okay, much better than last year means about 27% is what I'm saying, at least for exports. Then, no, what we are keeping out for.
It will be more than 27%. Definitely, that is our target.
Okay, and just in terms of overall margins, then how do we see that moving as well going forward? What is the outlook for margins that you're keeping? FY25, 12.7%, right? So versus FY24, a bit of a subduedness. Overall EBITDA margin outlook.
So we would look at the total amount of money we earn rather than percentage, as we have always said in my calls. We did 265 crores again, which is the highest. We did 69 crores in EBITDA in the last quarter, which is again the highest. We did about 583 crores sale, which is again the highest. And I would expect the EBITDA also to grow, by 10% plus in this year. So what we did, we are aiming to touch, 300 crores in EBITDA this year.
Okay, aiming to touch 300 crores in EBITDA. Also, sir, you do have some announcements that came in, I think, on capacity expansion for your subsidiaries as well, right? So could you help us understand in terms of what is the new product line that could be added there, as well as what is this in terms of strategic move for both the subsidiaries where you're planning your expansion?
So we are planning to add capacities in MDEA. It is called methyl diethanolamine, MEEA, monomethyl ethanolamine. And then we are planning to expand our pharma ethoxylates capacities. We are planning to extend our loop ethoxylation expertise. Plus, we are planning to add this year more products on the amine chemistry and more on the ester chemistry this year, both at Rossari Unitop and even some products in TriStar. One big focus which we pushed last year was on our R&D, and we have recruited quite a number. I think we have expanded our R&D strength by nearly 4 times last year. We are opening up in the TriStar facility a beautiful state-of-the-art R&D. And in terms of our gross margins, if you see, our gross margins have been highest ever in our Rossari history. But we have spent a lot of money on creating a market for Rossari products globally. We have taken part in more than 25 exhibitions in the last year. We have added more than 150 people, and mostly in sales, basically last year. And this year we also divided, our focus into the B2B business, which is our strength. But we have a small consumer-focused businesses. And this has been a drain on EBITDA in the past year, and we hope that these do well so that our EBITDA as a percentage also which improves. But our focus would be to grow our EBITDA as an amount always.
Okay, continue to grow your EBITDA as well. 300 crores is what we could expect in FY26. Thank you so much, sir, for joining in with us on the show and talking to us about the outlook of the company going forward in terms of growth. 10 to 15% for the overall business in FY26 is what we could expect as well. But on that note, we're going to slip into a very short break. We'll get you more news and updates on the other side.
Welcome back. Tejas Networks is a stock which has taken a big fall. Just to quickly run you through the numbers, the revenue is down 28% on a quarter-on-quarter basis. Though on a year-on-year basis, it's gone up by close to about 44%. But look at the way the EBITDA has fallen. The EBITDA for the company was moving at a pretty good trajectory. It was about 300 crore, went to 550 crore, but it's dropped off to 121 crore in Q4. And there is a provision for inventory obsolescence or write-down of 117 crore, which could have affected the company's bottom line. Even on the bottom line, the company has reported a loss in Q4 at nearly 71.8 crore rupees. And that doesn't seem to be the only problem. Now that the BSNL deal, because they were executing, maybe that's, dropped off to some extent. The order book has also halved on a sequential basis from being more than 2,000 crore, 2,700 crore. It's just come down to 1,000 crore rupees. So loss this time, margins have shrunk considerably, and the order book has tanked. So these are some of the concerns weighing on the stock.
Absolutely. These are big concerns that are coming in for Tejas Network as well. That's why the stock is down 10.8% as of now, almost near the day's lowest point. But yes, that's Tejas Networks. Nonetheless, we're seeing the markets managing to hold on to gains. Nifty almost around that day's high level. We're keeping it around that level, 24,237. So keeping an eye out on the markets. But with that, we're going to wind down this edition of Trading Hour on CNBC-TV18. Thank you so much from Rima, myself, as well as the team who put this show together. Don't go anywhere. Up next, you have Halftime Report.